We had a couple of these today. They both look the same. Call it the Super Puke. When people puke, that's a slang word for exit a position for a loser. When longs puke, it means they got thrown off the boat. If longs are sellers and there's less longs or less sellers, just think of yourself. If you're long and you finally get stopped out and then it runs a higher, you're like, I get stopped out and then it goes. Think about that. Relate to how that feels when it's happened to you. If you've traded for 5 minutes or 5 years, you know what that probably feels like. And now you want to put yourself in a position to see what it feels like when most of the rest of the market has that happen to them, because this is why it happens. Let me play it. You're going to see the market, number one, have the context and the setup of going through some areas. All right. So you have a pretty good idea. Longs are like, well, I'll stay long until it gets below here or below here. Right. So just like where you would put your sell stop. So what we show is this column in here will light up. Let me stop it. Will light up a bunch of green hollow bars. Why green? Because it's showing longs puking with sell stops. Let me play it. And you'll see this fire up right there. You could see as I stopped it, all these pink boxes are sell orders, market orders over 100. All these little boxes in here where my cursor is essentially this plotted in the bar. And this number, minus 1573, is the total number of orders that were sell market orders, that originated as sell market orders. Why do you use a sell market order mostly? To probably exit a long position and probably for a loser. Well, guess what? That's how most people use it. So when you get this, and you're able to get quickly above where they started, that's bullish. That's a bottom. That's a low. Not have to be the low for the day, but a temporary low enough to either cover a short if you're short, get long if you're bullish, but to be able to see it strips out the randomness and allows you to answer the question of why markets move. So not only do you get less longs with all of this, but you start to see all the shorts that pile in. And our laser goes green to red. And then we rally. If I told you this in real time like we do in the room and didn't tell you why, you'd like me more. But you're getting the why in here. Why? Strip out the randomness. You see me drawing it up in real time. And the laser's red. So this is don't be stuck short with all these clowns. Understand what this dynamic showed, proved. Know that when you're long, you're a seller. And when you get stopped out, you're no longer long, and therefore you're no longer a seller. And if there's less sellers above, that's why price of anything goes up. You need that dynamic of less sellers. You don't get less sellers. It's going to be hard to go up. You got more sellers selling houses. When you're selling your house, it's going to be hard to get a higher price because everybody on your block selling their house. And the dynamic of less longs, less sellers, because longs puke and shorts get stuck, create the upsides to the right side, and it's no longer random anymore. Less longs, and then, like I said, more shorts, which is this red laser and these reds that come in and everything else. When you get more, what are shorts? After you're short, are you a buyer or a seller? You're a buyer. So if there's more shorts, there's more buyers. Well, I just walked you through less longs. There's less sellers. Less sellers, more buyers. Wouldn't that be a combination that would exist for the price of anything to go up?